Well, that was the governor speaking about the monetary policy resolution, and as he clearly indicated, he was not willing to take any questions on the differences between the government and the Reserve Bank of India. And he kept reiterating that this is a press conference to discuss only the monetary policy statement and the recommendations of the Monetary Policy Committee, but that doesn't leave markets or observers any wiser. But let me now turn to Praveen Kumar Gupta, MD, Retail and Digital Banking, State Bank of India. Mr. Gupta, thank you so much for joining us here. There are two, suggestions made by the RBI in Part B of the monetary policy recommendation relating to digital banking. One is about having an ombudsman for retail digital transactions, and the other is about extending the cover as far as, retail digital transactions in terms of liability of the customer. How far do you think these will go towards furthering the use of digital transactions and furthering the use of digital money? Because as we've seen, post-demonetization, cash transactions have returned to the economy. So despite the spurt that we got for digital transactions, now we're back to square one. So will these help, Praveen?
No, I think, Maithili, if you look at the digital transactions, the way they have been growing, there has been a substantial growth in the digital transactions, particularly on the UPI side. And we do expect that the digital transactions to continue to grow. In fact, some of the data which I have is there is almost 400% growth in the UPI transactions that have happened in the recent past on year-on-year basis. See, we already have the ombudsman scheme, even within the bank also. Most of the digital transactions do go to our internal ombudsman. In fact, within the bank, we already had one internal ombudsman. We are going to appoint one more who will take care of primarily the digital transactions. So another ombudsman to look after the digital transactions just to take care of the increase in the volumes, I think is okay. There is no issue as far as the banks are concerned. The second point they made was regarding this prepaid instruments. I think what Mr. Kanungo said was that some of the prepaid instruments were not really covered by the existing limited liability circular which the RBI had issued, and they are going to cover them also under this scheme. So as far as banks are concerned, I think all the earlier existing digital transactions are already covered by the limited liability circular which the RBI had issued. So for the banks, there is no real impact on account of this. Just to take on the other issue which really affects the bank, I think, is the move to a common benchmark from 1st April. I think what RBI has stipulated today is all the retail loans and MSME loans will move to external benchmark. They are prescribed 3 or 4 external benchmarks that can be used, that is including the repo rate or the 91-day or the 182 days treasury bill rates or external benchmark published by FPIL. So what they have prescribed is all the retail loans, housing loans, auto, etc. will move to external benchmark if they are on a floating rate basis. I think other than housing loan, most of the other retail loans are already on fixed rate basis, so probably they are not getting impacted. But the housing loan will definitely get impacted, and the MSME loans also will move to external benchmark. That is something I think as banks will have to come up with, what kind of external benchmark we'll use, and that I think is going to be a major change as far as the banks are concerned.
Oh, well, absolutely. And there also is the issue of whether you will have the same external benchmark for all loans, or whether it will be free for you to choose which external benchmark to use in the case of retail consumers, which one to use in the case of MSME. And the RBI has also said that, a change will be allowed only when there is a change in the rating. Now, does this not show a rather naive belief in the competence of rating agencies? And would you be happy with a situation where the regulator tells you what benchmark to use rather than leaving it to the market? Because if I remember right, there was a lot of unhappiness in the banking circles when the RBI first talked of base rate, MCLR, and now there seems to be a further transgression into the space of commercial banks. Praveen?
I think we still need to wait for the guidelines. See, as of now, what they have announced is there are 4 benchmarks which they said will be allowed actually. So, the third already, 3 are very clear. One is the repo rate or the 91-day or 182 treasury bills, and they say that any other which is published by FIBL, that we have to see what exactly would that be. But also what they have said is that you can use the same benchmark for one asset class, which means that for the different asset classes, different benchmarks can be used. But I think let us wait for the guidelines. Only thing is that what it will definitely do is bring about some uniformity in the way the banks actually quote the rates. And only the spread cannot be changed. I think the benchmark probably can continue to use, but the spread can be changed only when there is a change in the credit rating, and that is what the current guidelines that they have issued today say. But I think we still need to see the detailed guidelines when they come.
The banks, given that on the deposit front, interest rates are fixed. So you really don't have the flexibility that banks abroad have. So is the RBI trying to force through a kind of change before the market is ready for it? And does this in any case, in fact, further hamper the flexibility of banks? Praveen?
Yes, it does to some extent, but I think this is something which was coming, as you know, that we already had a committee report and the draft report of RBI was already there, the draft guidelines were already there. But I think if you look at how the market evolves, I think maybe the banks will come up with more floating rate products actually. But again, it's only a one size of the book which is getting affected by it. There is a large portion of the book is not getting affected. To begin with, I think the portion of the bank's book which is getting impacted is very small. So I don't really think that this will have a major impact as far as the bank's NIMs are concerned.
Nilesh is with us. Nilesh, today's close, as the screen would tell you, has nothing to do with the policy statement because there's not much that came out which could be market moving. But even so, do you think that this is the kind of volatility that we need to brace ourselves for? Events will come and go. You have an OPEC meet lined up, that's tomorrow. Then you have what may happen with the Brexit vote next week. All that talk about tariff truce, whether or not that will actually be the reality that we'll stare at come 2019. In the wake of all of this, can one take an aggressive call with their portfolio management, or will they have to be defensive and cautious?
I think it will pay to be defensive and cautious, not because of Brexit or tariff war kind of thing, but more because of our election-related uncertainty, as well as what will happen to oil prices if OPEC decides to cut the production. Brexit, we can be passerby. It's more important for Britain. It's more important for some Indian companies who have their businesses in Britain. But from an overall market point of view, Britain is no longer the colonial master which we had. For us, oil and elections are two more critical factors. And clearly, this is time to be a little bit more defensive. Valuations have corrected. They are now at around historical average valuation. But over the next 6 months, both oil and elections will continue to have bigger impact than just the pure valuation.
Yes, and so if one needs to be a little cautious and defensive in managing their portfolios, Nilesh, what would be a prudent strategy you would recommend? Is it time to increase cash levels? Is it time to take some exposure to gold to cushion your portfolio against volatility?
I'll do a little bit of self-selling for mutual funds. There is a category of fund called Balance Advantage Fund, where depending upon the valuation, most of the fund houses change or alter allocation between debt and equity. And this funds retain equity fund status courtesy balance amount going into equity arbitrage positions. So if you don't want to make those adjustments in your portfolio looking at the valuation of the market, then you can trust fund manager to do the asset allocation. And going forward, I believe this kind of products, the asset allocation products, will be more appropriate for investors. So either you can create a defensive portfolio on your own, maintaining neutral allocation, don't increase too much cash, but just neutral allocation, or otherwise you can trust Balance Advantage Fund to create appropriate allocation looking at the valuation.
Okay, fair point indeed. Just hold that thought there. Nilesh Shah and Abhik Barwa continue to be with us, and we'll be joined very shortly Mr. R. Gandhi as well. But Abhi, coming to you, you heard the governor now in the press conference, his Deputy Governor Viral Acharya, also speak very categorically about NBFC liquidity. My own sense is that he wanted to set the record straight, and the last part of his statement was really a message to New Delhi that there are way too many instruments on NBFC liquidity. We will first exhaust those. CRR cut is not happening. And he of course then went on to say the system-wide liquidity is good. In fact, credit growth is upwards of nominal GDP growth. What are the signs that you're going to pick up as far as liquidity debate is concerned? Because that seems to be the big bone of contention between Mint Street and North Block right now. Is this all that they're going to do on liquidity? I know another OMO lined up in December. This really was a terse message for New Delhi to kind of back off on the liquidity demand, or will we see this erupt once again on the 14th of December when the board meets?
No, I think the liquidity shortage is fairly large. It was about 1.1 trillion rupees yesterday. But that said, the RBI is very clear that it will address the liquidity problem at a systemic level through market instruments rather than a sledgehammer like the CRR. And this has been the RBI's stance for the last, ever since they adopted this new inflation targeting model. So I see no problem with that. There have been incentives coming the way of banks for lending to NBFCs, to the MSME sector in terms of fall CR, CRR, etc., SLR, etc. And I think again the RBI's message is that it will not adopt something which is out of sync with its broad philosophy of using market measures and incentives within the market to push lending to the sectors that the government sees as vulnerable. I think that's a cautious and prudent move, given the fact that there are inherent risks in sectors like the MSMEs. We've seen a problem with the NBFC sector, and these have to be recognized and analyzed very carefully before you do something very dramatic like lowering their risk weights and so on, and pushing large amounts of credit in there. So I think the RBI is walking the tightrope between the various pressures that are emerging from different quarters. But I think it is sticking to its kind of philosophy on the way it wants to manage these things, and I commend it for it, because I think with depositor money you need to be cognizant of the risks involved in exposing your book to to a particular sector, which could lead to large defaults. So I think assessing the long-term problems and issues is a way of addressing this on a more comprehensive, sustainable basis. I think the move towards an external benchmark is also is welcome, in the sense that it will make things more transparent and address some of the concerns that people have raised, that MSMEs get short shrift and so on. So I think the broad message is they are willing to come to the walk the sort of middle path, but within the confines of a market driven apparatus and incentives within that market driven apparatus.
Okay, just hold that thought there. I've also got Nilesh Shah and Jayesh Mehta, and Jayesh, I'll come to you. The point that Abhi Barua makes is an important point. The system liquidity deficit is at about 1 lakh crore rupees, and even then the RBI perhaps is right, many people will say, to exhaust every other instrument before even looking at a CRR cut, and the governor and deputy were very, very categorical in stating so. In fact, they do believe that NBFCs and HFCs, there's a partial credit enhancement that has happened as far as the bond picture is concerned. Relaxed rules for securitization have helped as well. OMOs lined up. Are you on board with how liquidity is being managed, even though from a system-wide point of view they believe that credit growth is outpacing nominal GDP growth, and so there cannot be a concern of liquidity squeeze, so to say? Jayesh?
Yeah, I think, see, we have been used to positive liquidity in past. I think from 2013 onwards, we are, for whatever reason, depending on the stance, it could be anywhere from 40,000 crores to 1 lakh crores negative liquidity, and we are continuing with that. So even in the best situation on liquidity, we would have maybe still 30-40,000 crores negative. And I think that's what they are looking at it on a systemic short-term liquidity mismatch, or what they call it frictional mismatch basis. And that's where and they still believe that, if you look at last fortnight, it was more because of WMA and all that. So when we see the headline number 1 lakh crore is what people borrow in repo and LAF, and then we feel that that's the system liquidity. But yeah, maybe out of that 30, 40, 50,000 crores is intentional shortfall they want to keep, and the rest is anyway they are providing durability, and I think durable liquidity. And Deputy Governor Acharya also talked about it. Looking at it, they may continue till March to infuse durable liquidity.
Hold that thought. I want to go across. Yeah, Jayesh, give me a minute. I want to go across to Nilesh Shah. And Nilesh, the RBI governor left it open-ended, but do you believe he is also kindled the hope of a reversal in monetary policy? Because he goes on to say that commensurate action will be taken if the downside risks are going to disappear, and chances are that they will. He, of course, then went on to say that data required for the durability of inflation will be important. He will keep a close eye as far as both forex, the exchange rate is concerned, and also the crude futures. But is there hope that there will perhaps be monetary policy revision downwards? Could the trajectory move downwards despite the fact that Fed could actually be hiking rates, and one expects 5 rate hikes to happen?
So assuming that RBI is watching US Fed futures just like they are watching crude futures, then certainly they will take into account that the probability of rate hike by US Fed over 2019 and 2020 have dramatically come down. So market is pricing in, based on Fed futures, 1 rate hike in December, but from 3 rate hikes in 2019 and 2 more in first half of 2020, the probabilities have come down dramatically. So using the same market apparatus, RBI will be able to conclude that despite a rate hike by US Fed in December, the future curve of rate hikes has come down dramatically, and hence that will give them more elbow room. My guess is that RBI will focus on core inflation also, which probably they have not uttered yet, but certainly that number has remained in a reasonably higher range of RBI's comfort level, between 4 to 6%. And maybe somewhere they are looking at not only food inflation coming down, but they are also looking at non-food, non-fuel inflation also coming down dramatically. So maybe they'll evaluate all these factors together to take a call, but certainly they have given one ray of hope to the market that if data supports, then RBI will be willing to change the stance.
I want to go across to Upasana Bharadwaj and Maithili Bhusurmat, who are both joining us back. And Upasana, I'll come to you. And this is a question that Maithili had raised early on. Through the press conference, it did come about the asymmetric action of the RBI. When inflation breaches 4% level, all hell breaks loose and there is so much of ammunition that's used. But when inflation is undershooting and there is a very sharp revision downwards of projections also, there isn't much action required. In fact, all that has been said is that, data will be important to see the durability of inflation and all of that. Is there in some sense, denying of the fact that if inflation is in the undershooting, the policy action needs to be a lot different and perhaps a lot more robust than when inflation rises? Upasana?
I'd like to highlight that, mostly what happens is when we start seeing too low inflation levels, that's when, especially right now, RBI has very correctly, pointed out that inflation has moved too sharply, too fast. and probably it is the sustainability of these trends which probably results in such kind of asymmetric behavior. I think largely we all have seen the kind of moves. Of course, we know that in part we could be seeing the food inflation to be structurally low, but there's also some kind of cyclicity as well. And if it is a combination of the two, we do not know how exactly it's going to revert back and how high it's going to go that time, especially at a point when we know that the headline inflation is largely being dragged down because of food inflation and not because of core. Core is still sticky and elevated, and that too has been pointed out by RBI briefly though in the policy statement. So I think somewhere RBI tends to be a little more conservative on that account, largely because they doubt the sustainability of the downside move that we're seeing in the food inflation.
Maithili, the governor was very categorical, and even Veeralacharya mentioned twice over that the credit growth is outpacing the nominal growth in the GDP, which essentially means that there is far more lending that's happening, lending that's far more robust. The question really is, are we seeing a reflection of that in terms of investments that are breaking ground? I mean, one of the reasons why growth has been retained at 7.4% is that the RBI sees acceleration in investment activity, it sees output gap closing, it sees greater utilization, picking up. My question really is that this lending that the RBI is talking about and referring to is obviously, is a message to the central government from the central bank that there is no liquidity concern, there is lending that's happening. But is it commensurate with the investment activity one is seeing on the ground?
Well, one thing one must remember is that this growth that the RBI is talking about is on a very low base. The past few years, we've seen virtually no lending by banks. In fact, credit at times has even contracted. So this is on a very low base, number one. Number two, the RBI has various ways of, computing this credit growth. It could only include bank lending, include CPs, it includes lending by NBFCs. So there are various ways. One will have to look at the numbers a little more closely to see that these are comparable numbers. It's also a question of where are the banks lending? Where is this lending going? Is it all retail lending? And ultimately, a country does need lending in productive avenues, including infrastructure. And that is something where we've seen virtually no lending by banks to any of the infrastructure sectors. In fact, the problem in infrastructure lending still remains. And as we're seeing, there are reports which say that soon the demand for power in this country will go up. Now, where is the demand for power going to be met when you have stressed power sector assets and no clue or no hint of any kind of closure on that? So I think one will have to look at the RBI numbers a little bit more closely, and I think this is more to reiterate to the government that don't worry, there is enough and more credit. But I'm not very sure, because at the grassroots, at the ground level, MSMEs are still complaining of lack of credit, because in the past a lot of the lending, heavy lifting that banks had stopped doing was taken over by NBFCs, and now NBFCs are also not in a position to lend because banks in turn are not willing to lend to NBFCs. So I'm not sure that the numbers at the RBI can be taken entirely at face value. Yes, credit offtake has improved, but it's nowhere near what we need to ensure that growth gets sustained even at that 7.5% plus.
SK Ghosh is joining us of SBI, and Soumya, I will come to you on the point that Maithili is making, that while there are repeated references to credit growth picking up, it is not commensurate with what an economy even growing at 7.4% will require. One doesn't know which part of the economy is really, looking at this credit offtake. Is this retail part? Is this infrastructure? And things like that. Because if it were infrastructure, investment is not picking up at the same pace. In fact, Q2 numbers tell us that, the bounce back in the economy, at least the euphoria, was a little short-lived as compared to Q1. So I'm just trying to understand here how true is the picture and how correct is the picture of this credit offtake. She's right in pointing out it's a low base, but just to take the conversation forward on credit offtake and what it will mean for the economic activity.
No, I mean, good afternoon. I appreciate what Maithili has been saying, and some part of the argument she made is maybe probably correct, but there is also another aspect to this argument. Let me put it in the following way. First, I think it's true that the credit growth this year has been strong. It's at a 5-year high, and if you want to look into if you abstract from that year-on-year comparison, if you just look into the incremental credit growth also, I think that has also remained quite strong in September. In October, the incremental credit growth, but however, has actually declined. But the point which I am trying to make is that the credit growth which had happened in September was not only to NBFC, but it also happened to large corporates, it also happened to retail, it also happened to other sectors, for example, like infrastructure like roads. But in October, there is an evidence that the credit growth on an incremental basis, I mean the total credit expansion has actually slowed down in October. So that's a disturbing sign, because retail credit growth has also slowed down in October. This data was released on November 30 along with the GDP data, but so therefore this data may have largely got unnoticed. But my sense is that credit growth, yes, what the governor said was more broad-based in September when the data was released. But if I look to the October data, now there is clear evidences of the growth of these numbers slowing down. The only good thing is that the numbers still is a departure from the last 2 years, when in September we had a large credit expansion followed by a negative credit growth in October. But this year the credit growth, even though has dipped down in October, has actually still is positive. So that's one positive thing we can take out from the credit data. But I will closely watch the November credit numbers, because November was the month when we had seen that the passenger vehicle sale has been negative, also the commercial vehicle sale has been slowing down, and also the retail credit growth in October has declined. So on a net basis, I will watch out for the November data to take any definitive trends on where the credit growth is actually going in the current fiscal.
No, you're hitting the nail on its head, and Jayesh, I'll take that question forward with you and then go across to Upasana on this, because if you actually look at the passenger vehicle sales for the top 3 automakers in this country, Maruti, Hyundai and all of those people, it was down. So you know, if I look at a high frequency indicator like auto sales, that was down. We've been speaking to cement companies and they tell us production and sales are both sluggish. So is steel telling us that real estate is a trend that hasn't picked up at all. You know, it will be important to watch the credit growth from November before we really raise a toast to what the RBI is telling us as far as credit growth outpacing nominal GDP growth is concerned. I think that statement is more made for the consumption of New Delhi and less for experts like yourselves. Jayesh.
Yeah, so I would add 2 things. One, of course, I don't have the actual data. Maybe somebody can throw that light. But what we have been hearing from the clients of late, particularly banks, this huge credit pickup from government companies, right? So basically road, power. So a lot of government companies have been borrowing a lot. So while we may not see the credit growth really picking up on the private sector and stuff like that, but the government companies have been tapping the bank loan market very aggressively in last 2 quarters. So that's one part of it, right? And the second part, yes, one can definitely attribute to NBFCs and other things in terms of auto slowdown, but auto had picked up dramatically. And also one is to look at it like, again, it's an anecdotal situation. When the fuel prices were the highest, you know, we have 2 aggregators of cabs, right? So there was a lot of enthusiasm there, and the category which we are seeing the sales drop is mainly with the 2 taxi aggregators, and that's where they went on the strike and other stuff. There was some disturbance there, and the margins and the incentives have really dropped there. So maybe that also could have impacted the auto sales.
Okay, Jayesh, just give me a minute because I want to go across to Upasana, and very quickly before talking about inflation once again to you and Maithili, the question is 7.4% growth is a figure that has come under a lot of speculation. Many people believe Q2 at 7.1%, the credit squeeze or the liquidity squeeze is going to be telling in the second half, and so 7.4% is a figure that has been oft debated. Will you repose your faith with what the RBI is essentially looking at? They believe, you know, utilization is going up, investment is going to accelerate. They want to retain growth figures at 7.4% and 7.5% for H1 of fiscal year 20. Are these numbers that you will go with, or would you want to be a little more conservative here given how the situation is unfolding and what the high frequency data is telling us?
Is the question addressed to me?
Upasana? Yes, that's right. Upasana?
Yes. Yeah. Yes, of course. I mean, 7.4% being retained is clearly something which has significant downside risk, which RBI has highlighted, saying that there is a downside risk as against a balance of risks in the previous statement. But having said that, achieving a 7.2 or 7.3% average in the second half of the year looks extremely difficult. And also, I'd like to point out one thing that if we look at the revisions that have happened to the inflation trajectory, a significant downward revision, that clearly means that somewhere the core inflation is also expected to be moderating much faster. And if that is the case, then somewhere retaining of 7.4% with a 7.2% average in the second half of the year looks a little difficult, and I find some kind of a disconnect there as well. So somewhere I believe that even if the inflation trajectory falls in place, I think the growth will be closer to 7.1%, and we ourselves were at 7.3% earlier. After the second quarter GDP, we've revised it down by 20 basis, so we are at 7.1% now for this year.
Soumya, you agree with the growth assessment of the RBI? 7.4% you think is going to be doable in the circumstances that we are talking about?
No, I think the growth numbers will sooner or later be revised downwards. I think it's very difficult to revise the inflation and growth forecast downwards in one policy. But let me give you some interesting facts. I was just looking through the RBI fan chart. The growth projections for the current fiscal Q3 at the beginning of the year was 7.2% in April 2019. This number was revised upwards to 7.6% in the August 18 policy. So basically the RBI was very sanguine about growth at that point of time, and from the 7.6 this has now been reduced to 7.1 for the next quarter. And for the Q4 also, the growth number has been revised downwards from 7.3% to 7%. So if you take the average of the 4 quarters with the 7.1 and 7% growth rate, I think the average just exactly comes to like 7.4%. So I think it's purely a balancing exercise which has been done, and our projections for the entire year are with at 7.2% now with a clear downside, and I don't see any reason why the fourth quarter growth number should be more than 7%. In all probabilities, both Q3 and Q4 should be below 7%, the way the indicators, the leading indicators and the other things that are currently indicating.
Okay, Maithili, more than growth, I want to quickly pick your brains before I go back to talking growth and everything. 3 questions, and kudos to people. The governor selects who's going to ask questions, so it's not as if you can get a chance or you have a fair chance of getting a chance. But 3 people asked a question on RBI versus government in 3 different forms, and all of that was ignored. And one man then finally made a last-ditch attempt and said, do you stand by what Viralacharya said publicly? Along expected lines, or did you actually expect the governor to have at least cleared the air on this? Because by choosing not to talk, has he fueled the fire even further?
Well, I guess given the kind of controversy that has been raging, it was more prudent for him to have kept quiet. But under this governor, I think we've all got used to having very sanitized press conferences. Because in the past, I think the governors used to take much longer press conferences, and almost everybody was given a chance to ask questions. Whereas here it is a case of pick and choose. So we do have very sanitized versions of press conferences, and that is why I think part of the angst of the market participants and even observers like us is that we don't have enough communication from the central bank, and communication is very powerful. This is a very important instrument that the RBI under the present governor has completely missed out on, and that I think is part of the reason why there is so much opacity behind what the RBI does. Because even now Viralacharya talked about the RBI having gone into the reasons for the liquidity crunch and then devised the instruments accordingly. Now if you have undergone some kind of study, done a study on the reasons for the stress, would it not have been better in the best interests of transparency to say what is the RBI's view or what are the underlying reasons for the stress? Then markets, the concerns would have been assuaged a great deal. But I think we have to live with the fact that the RBI under the present dispensation is far more opaque than it used to be, and we have to live with the sanitized press conference, Supriya. That's a given.
No, fair point indeed. And I think one of the questions that you wanted to ask, an external benchmark of new floating rate loans by banks. Jayesh, before I take a breather, and I'm going to come back with more information and one more guest, but before I take a breather, external benchmark for new floating rate loans by banks. And Maithili here believes this is yet another interference with how commercial banks should be working. Is that your sense as well? Jayesh?
Is that to Maitli or to me? Yeah. Hi. So I always have been a strong proponent. We should not be having MCLR because that's every bank has different MCLR. So, and I think this has been in works since long. I think they are getting a lot of pressure, so they are doing it part by part. But basically, you need to have a benchmark. Frankly, of course, base rate, MCLR, all that is not really required. But if you have a floating rate, then you need to have a market range related benchmark which can be traceable. And that's what the thing is. Of course, a lot of people do argue that my liabilities are fixed and stuff like that. But if you look at average duration of most of the banks, I'm talking industry-wide, is also floating. You may have a fixed rate deposit, but your duration is 8 months. So this is effectively floating rate liabilities you do have. So from that perspective, but at this juncture there is resistance and therefore RBI is not pushing it across the board, and they have just said, okay, to start with, we'll start with this particular thing. And I think it's a very positive situation because it does reflect monetary action, monetary rate transmission to the end users, like your housing, right? They would never get that situational benefit, which definitely will now transform if it is linked to a market benchmark.
Okay, on that note, I'm going to take a really quick breather. Please do stay with us. I'm back in a moment and we'll take this conversation forward with all of you. So, SK Ghosh, Upasana Bhardwaj, Jayesh Mehta, and of course, Maitli Husnuma. Please stay with us. Back in a moment right here on ET Now. One of the reasons why inflation has been projected sharply downwards, and of course the situation has completely changed from $85 a barrel to 60 right now, but a lot will depend on the OPEC supply decision later this weekend. How much of a variable is that going to be, not just in monetary policy but inflation projection and all of that as well? I know oil right now has been considered a tailwind, but till 2 months back, the last Fed policy, oil was the big headwind.
Yes, I think clearly, RBI has also highlighted that in the statement. I think the decision will be very crucial. Again, the question here is we need to keep in mind that the crude oil price trajectory will be a function of the OPEC decision, along with the fact that there is a deteriorating global economic outlook also. So I think both of them taken together, of course, I think somewhere RBI would have assumed that on a balancing way, crude oil prices will not really go haywire. So, up to 65, 70, I guess, things can be kind of contained. Anyways, given the kind of correction that we've seen in crude oil prices, somewhere from what post-policy the governor kind of tried to suggest, they've probably taken a 60-65 as a range for the rest of next 6 to 9 months, dollar a barrel as a crude assumption. And if that is the case, then of course, if the OPEC decision was to cause a lot of turmoil in the market, then that could result in, again, upward revision. But again, the impact will come with a lag. So I think it is more about the first quarter of next year rather than an immediate revision to their second half of this financial year. So maybe at this point in time, it is more, closely we'll have to watch for how exactly the food prices really pan out, rather than oil price impact immediately, of course.
Okay. No, absolutely. And I think what the point that we haven't talked about is Rabi sowing has gone down and how that could be a potential risk as well. But I've got former Deputy Governor RBI, Mr. R. Gandhi, joining us right here. So please stay with us for a moment. I'll just finish this conversation and return right back. And Mr. Gandhi, thank you very much for being with us. Inflation projection has been sharply lowered, and even then calibrated tightening continues to be the stance. Do you believe that stance couldn't have changed too early, or is that been consciously done? And if inflation is going to undershoot so much, why could that stance not be changed? Mr. Gandhi.
Yeah, that's a bit of surprise, of course. But I can understand why the Reserve Bank or the MPC has not rushed into changing their stance, which they did only in the last policy meeting. So quickly to change, they would want kind of a very large-scale affirmation of continuing food inflation to be low, and the oil prices stability in the oil prices also. Possibly they had thought that let us wait for some time to get such indication and then change the stance. That looks like my assessment. Otherwise, it is a surprise that they did not go back to neutral.
Okay, it's a surprise they haven't gone back to neutral. Are you also surprised with the fact that the RBI is pointing out credit growth being ahead of nominal GDP growth, really pointing out to a pickup in economic activity? Because on the ground the situation may be a little different, and even though RBI is retaining growth numbers of 7.4%, many people believe that number will have to be revised lower, at least looking at the Q2 GDP projections and the liquidity crunch that is going to hit consumption. It has already hit consumption in the month of November if you go by auto sales, cement, steel, all sort of high frequency data.
See, GDP figures, as RBI has in the MPC statement, it has mentioned that the private capital formation has been on the upstick in the double digit for the past 3 quarters. So, and the industrial outlook, especially the capacity utilization, has been now noted to be more than the normal period average, the trend average. It is more than that, 76%. So these indicate that there could be revival in the industrial segment of the GDP. So that's why they are sanguine about the growth rate to be continuing at 7.4. So private consumption, it has though decelerated, it is kind of been compensated by the public sector consumption. That's a infrastructure expenditure that has been maintained continuously. So that is why you would find that possibly the growth, there will not be deceleration beyond that 7.4% which RBI has measured.
No, the reason why I also asked that question is that why is there no greater commitment to liquidity? I know Deputy Governor Viral Acharya and the Governor did maintain that there is a system-wide liquidity and that's not a constraint at all. But there's been a constant clamor from the industry and the government that, liquidity for the NBFCs, for instance, needs to be looked into far more closely. The RBI continues to maintain that OMOs and other instruments like that are being used and there is no liquidity constraint. From a system-wide perspective, perhaps there may not be a liquidity constraint, but why the lack of commitment on the NBFC liquidity? I know it wasn't perhaps the ambit of the MPC so much. Do you think that issue has been kept for the 14th December board meeting? I mean, what's your take on this? Because liquidity was a bigger point of contention and a bigger debate this time around than even interest rates were.
Say, liquidity, the Reserve Bank and the MPC will look at the overall liquidity only, not segment oriented. So, segment related specific measures, normally a central bank will not try to put in, because it affects, it will be distorting this whole situation. So, that is why generic liquidity, when it has assessed that it is sufficient, and the liquidity is supposed to flow between various segments based on the credit risk assessment and other risk factors, and paying appropriate price for that liquidity. So that is what, if NBFC sector or a particular any other segment is not getting liquidity, but we do see large scale reverse repo deposits by the banks into the Reserve Bank, that clearly means that the sectoral parties, they are not paying the right price for the liquidity that they want to acquire. So that there should be a readjustment on the pricing, and based on the risk assessment, then the liquidity will definitely flow to them instead of coming back to the central bank.
Okay, fair point. But are you in the camp that believes there could be a CRR cut to boost liquidity? Because the governor and the deputy governor were very categorical that CRR is not in the ambit of instruments that's being looked at? There are way too many instruments that the RBI has at its disposal right now, because there are some who believe that a CRR cut is perhaps going to boost liquidity, but then others who continue to say this is going to be a permanent liquidity boosting measure and perhaps the liquidity crunch is transient.
See, CRR as a policy tool has almost lost its relevance, in the sense that since it has been brought down to 4%, below 4% to bring down, it will not be easy, because this cash deposits which the banks keep with the Reserve Bank, they are normally required for their day-to-day operations like intraday liquidity that flows to the banks out of this balance. So to bring it below 4 or any other numbers, it will be actually be disturbing the day-to-day operations of the market. So I don't think CRR will be a tool which Reserve Bank will apply for managing the liquidity. So managing liquidity will be through the OMO operations and the day-to-day LAF operations, or different kinds of LAF. That's what typically Reserve Bank will do in addition to its forex operations.
Okay, I want to ask you a question that we at ET now have raised, and I think Maithili voiced this concern, that is the RBI action a little lopsided? Because when inflation breaches 4% level, there is havoc that's created and all kinds of policy instruments are put to use. But inflation, when it's undershooting, and at least the projections have been sharply lowered down, we are seeing a very benign action. We are almost seeing action that is going to be weighted. And if I may also add a question by stating clearly that one will have to wait and watch how the upside risk dissipates, is the governor giving us a ray of hope that policy trajectory could move downwards if factors were to evaporate and dissipate really?
See, but the factors which led to inflation being below, and further because of that, Reserve Bank has also revised its projection. They come from one, the food inflation, and the second is the oil. These two are the major factors which have brought down the current inflation much below the expected or forecasted ones. But food inflation always has the tendency to suddenly reverse its trend. It cannot be. You cannot completely believe that it will be sustainable for a longer period, unlike other type of inflation. And crude oil also, there are not clear indication from the international market that the lower prices has come to stay. So because of that, naturally there will be a hesitation to go just by these two indications alone so quickly. That's what I thought, that they may be waiting for further affirmation of these two little later. And added to that, the rest of the inflation, other than fuel and food, the other inflation is high. So it is sustaining more than 6% or more. So that is why possibly MPC thought that we have to wait for a little more before getting to admitting that either the stance to be changed or even think about rate cut or whatever. I would have actually preferred, expected that this time they will change the stance, but that, as I said, it was not to be.
Okay, a quick last question before I go, sir. Let you go, sir. External benchmark for new floating rate loans by banks. Many people believe this is almost pushing the envelope by the RBI. What do you make of this?
So it is not. It is 3 years before, when the whole thing started itself, it was made clear to everybody that one day the system should move towards the market-based benchmark for floating rate interest. So since the market-related benchmark was not available at that time, some alternate surrogate were thought of. It was clear to the Reserve Bank and to the market also that slowly Reserve Bank will be pushing the market to rely on market-based benchmark. So that is where now, because there is a large-scale expectation from various segments that whenever there is a rate action by the Reserve Bank, especially when the rates are being brought down, that monetary transmission is not taking place in a transparent manner. So to bring that, this kind of linkages will automatically be helpful. That's why now that there is a specific institution, specialized institution which has been brought to build the benchmark and maintain it in a very unbiased manner. So now the time is ripe to pick up those. So Reserve Bank has given alternate. Either they can pick up their policy rate or the T-bill rates or the benchmark which has been brought out by the RBI. So now the market has a choice, and slowly market should go completely towards market-based benchmark. So it is in the right direction. That's what I will feel.
Okay, Mr. Gandhi, thank you very much for being with us and sharing your views. Appreciate you joining us. I'll go back to my panel, and SK Ghosh, Jayesh Mehta and Maithili Bhusnurmat continue to be with us. And Maithili, one of the points, and I know your view at least on the external benchmark rate, but what about the aligning of SLR with liquidity coverage ratio from 19.5% to an 18% level over a period of time? Do you believe that's in line and will, in line as far as the liquidity management is really concerned?
Well, yes, it is true, because actually the liquidity coverage ratio, and when we have an SLR, there were always questions about why do we need to have a liquidity coverage ratio, since an SLR is virtually as liquid as you can expect, because it is backed by the sovereign and there is an active market in government securities. So this is quite okay, but the only issue that it poses is that government might find it difficult to raise its borrowing, because if the banks are not required to hold SLR to the extent that they were required to earlier, does it complicate matters for the government, given that in India governments do have pretty extravagant fiscal deficits? So how is the government going to find them? There's no ready market really. They will have to perhaps offer higher interest rates, and so that does pose some problems for a government looking to raise large amounts of money from the market. So yes, there could be issues going forward, but my sense is that until such time as there is active growth of credit demand, banks will still continue to hold both SLR as well as LCR. So this is only an enabler, and it doesn't pose a problem now, but going forward this could pose an issue for government raising its government T-bills, government bonds, etc. That could be an issue, because if banks are not mandatorily required to hold higher SLR, they could perhaps stop subscribing to government bonds.
Jayesh, you share that concern that for now there's going to be no issue, because in any case credit growth is not so robust, but going forward this could be a hindrance as far as government's own borrowing calendar and program are concerned? I mean, at least the quantum of borrowing and the rate?
Yeah, so actually, SLR only was government and state government bonds, and now, of course, LCR, which is a global mandate. So you can't have both, so you have to choose one, and then it's a global mandate. Global banks are implementing it, so you have to move towards it. But I'm not too sure that, okay, full requirement. So you have to have either SLR or LCR. You don't really require both. But even if it is pure LCR, you have a lot of instruments available. But banks would normally still prefer to have a large component of that as government bond and state development bond, because the liquidity there is the highest. So you do have some AAA and highly rated paper also available in that bucket, but banks from their prudential management will definitely still opt a larger percentage, even when it becomes 100% LCR. So they will actually go for larger percentage for government bonds. And hopefully we do get the fiscal deficit down in next 2-3 years.
No, fair point indeed, and I think fiscal deficit, they've already raised a red flag there. But SK Ghosh, going forward, what are going to be the key things that's going to play on the central governor's mind? Because yes, benign food has been flagged as a factor that has pulled prices down. So has oil, but both are risky assets, and they believe perishables can go up. They also believe you never know what happens with oil. Oil continues to be a risk on the upside, and how it's going to pan out. And will policy be really determined not by what really happens so much with these two things, but more really by what the Fed does? And there is expectation that there could perhaps be 5 rate hikes in the next 5 months.
No, I think the communication today of the central government has been very lucid. They have given clear directions to the market. They have given clear direction to the market in terms of liquidity, that they are going to do the OMO operations as required till March. And the other important thing which they have done, I think that's an extremely positive step, is that now they have, I think there is always a problem of the signal extraction in the literature, which is commonly called, means that the central bank may have more information and liquidity than the market participants. So actually, to break down that, the government, the RBI has now said it will give out information on CRR daily maintenance on an almost daily basis. So I think clear signal on the liquidity front, clear signal on the inflation projection front, saying that if the inflation continues to remain in the current rate, and if the projections are like this one, there could be some actions later on. So the central bank is pretty clear that if this is the situation, this will be the condition on liquidity, this will be the condition on rates. And even though it has maintained its forecast on growth, I believe that the next, maybe that growth, it could not reduce the growth forecast, because the central bank has been maintaining that the output gap is closed, even though we believe that that may not be a fair description of the state of things. So my sense is that a good policy, good communication, pragmatic decisions in the terms of liquidity management. So I think this all bodes well for the markets in the near term. But the only uncertainty which still remains is the oil. I think the central bank should not like to see an oil again getting back to the levels of 80 by the time the next policy is delivered. But as of now, I think a good policy that will drive the market in sync with what the central bank has said.
Okay. On that note, thank you very much, Soumyakant Ghosh, Jayesh Mehta, and of course Maitri Busnurwat for being with us. Take a quick breather, come back with plenty more programming. We track the market action for the day and what's in store tomorrow with Pankaj Poddar up next. So stay right here with us.